It's time to discuss bonds, boring bonds, stodgy bonds, reliable bonds. And they're going to especially seem boring after the stock investing that we talked about. But there's a reason for bonds' existence. And for those who want to sleep well at night, they turn out to be a decent alternative. But we hope that you'll at least see that a mixture of stocks and bonds might be best for you, especially if you're younger. If you're younger, I think you should be all in stocks myself, but that's why there's chocolate and vanilla, and some people like strawberry. So let's start with a joke. What's the difference between a man and a bond? The bond eventually matures. I hope you enjoyed that, ladies. Slide number 2, investing in bonds. What are bonds? Not James Bond, not Barry Bond. No, bonds represent loans to companies, corporate bonds, or state and local governments, municipal bonds, munis, or the federal government, treasury bonds, government bonds. If you're Walmart or the state of California, you don't go to your local credit union to borrow $2 billion. You go to the investment community and you say, hey, we're Walmart. We're the state of California. We're the United States Treasury. We like to borrow money. Will you lend it to us? And investors say, well, what are the terms? Well, we're going to pay you 4% or 6% interest for 20 years, 30 years, and then we'll pay you the money back. Okay. Bond holders, bond investors receive interest on the loan. The bond is repaid, the bond is redeemed, the bond matures in 1 to 30. Well, usually it's at least 5, 10, 20, 30 years. Some bonds are even longer. Bondholders are first in line for repayment if there's a default on the debt, on the loans. Well, actually, you got to pay the employees first and any taxes if there are taxes. Who's at the back of the line? Right, stockholders. That's why when a company goes bankrupt, the stockholders usually get nothing because the bondholders get to pick the carcass clean first before stockholders get anything left. Bond prices are far less volatile than stocks, but they still fluctuate? That doesn't make any sense. We're going to cover that in detail because that's the trickiest part of bonds. The average return over decades has been 2, 5, 7%. It's gone up in the past. It's gone down recently. But after 2022, prices have fallen. Interest rates have gone up. So bonds are looking more attractive than they have been for over a decade. Bonds are good intermediate term investments, and they also make decent long-term investments for people who want to sleep at night. There is actually a way for bonds to be short-term investments, but we're not going to discuss that. We discussed that in the Introduction to Investments class, which I hope you'll take. And it's free it's on there for free already, so you can go through this. If bonds really do excite you, which bonds are not that exciting. Slide number 3. Why do investors buy bonds? Well, the biggest reason you buy bonds is for the income. That's the real reason you buy bonds. Investors know the interest rate. Typically, bonds pay investors twice a year. Some bonds pay monthly, quarterly, yearly, but typical bonds will pay every 6 months. And the face value, the par value, the principal will be paid at maturity. Although there is always a risk of default, meaning that they didn't pay you back the interest, the principal. Some people don't pay their credit cards or their car payments, their house payments. Normally, the risk of default is very, very small. It happens very sparingly. It doesn't happen often at all. If the risk is high, the bonds are usually referred to as non-investment grade bonds. Really, they call them junk bonds. Not a very kind name, but we'll see that sometimes junk bonds can be screaming good deals if you don't believe that the company's not going to go under. And you may get the appreciation of your bond value. You may be able to sell your bond to someone else at a higher price if the interest rate on your bond is higher than the current market rate. What? Well, we're going to see that there's a relationship, an inverse relationship between interest rates and bond prices. If interest rates go down, bond prices go up. If interest rates go up, bond prices go down. Think of a seesaw, which is a perfect analogy. And last year, 2022, bond prices went down because interest rates went up. But they were paying just not very much anyway. So we knew interest rates had to go up. We just didn't know this stupid microbe would throw several monkey wrenches into our economy and make for a supply imbalance, a supply chain disruption, and cause inflation, the stupid microbe. Slide number 4. Why sell bonds? Why would an entity sell bonds? Well, they need to borrow money to raise money to operate or expand, build a new factory, expand into a new country, build new or upgrade older schools. Does this sound familiar? Have you been on a campus lately? It's a war zone. There are so many new buildings, and they've gotten rid of all the old gorgeous, not all of them, not yet, but eventually I'm assuming they're going to get rid of all the old gorgeous little buildings and putting up these new monstrosities that have so far won us 2 architectural onion awards. Orchid awards are for when you make a beautiful building, and onion awards are for when you make an ugly building, like the math science building, which looks literally like a prison with bars around. It's unbelievable. I mean, who was the architect? Whoever it was, they're getting paid too much. What if you need to finance a war? You don't go down to the credit union. We need $3 trillion to invade Iraq. They can get better interest rates than if they went to a bank or a money lending entity. And sometimes you just can't go to a bank. The bank just says, I don't have that kind of money. Almost every election year in California, the voters are asked to approve a bond proposition for parks, schools, water projects, transportation, emergency public safety equipment. The state of California, or the city of Chula Vista, or Southwestern Community College District, then sells the bonds to pay for the project and must pay the interest and pay back the principal over 30 years. Do you believe that the voters really understand what they're voting for? They're voting to increase their taxes over the next 30 years? I don't think most people understand. I mean, the voters in the South Bay love us. They've always, in the past, approved the bond issues. But do they really understand that it's going to make their property taxes higher for 30 years? But folks, we didn't have a bake sale to build that stadium, okay? I mean, that's not how it works. We had to go out and sell bonds to the general public, and the voters had to approve it. And people do like us. They buy our bonds. They like our bonds. Why sell bonds continued? In the case where the bond issuer is a corporation, sometimes it is difficult, not advantageous, or impossible to sell stock, and the interest is a tax-deductible expense for corporations, whereas dividends from the last chapter, no, dividends are not a tax-deductible expense. And so if you're a company and you want to increase your deductions and pay fewer dollars in taxes, interest payments are tax-deductible. And entities issue bonds to take advantage of financial leverage. And this is a tricky little topic, but the idea is you're using other people's money to make your money, right? You would have to come up with a certain amount of money to make the money. No, I'm going to borrow it, and that'll help me build the plant I need or create this product that I'm interested in. Bonds are debt financing. Corporations, municipalities, or the federal government borrow them for many of the same reasons that individual borrows do to finance their operation. There's just a whole lot more zeros involved, right? The numbers are a lot bigger. Stocks, on the other hand, are equity financing. The corporation is selling a piece of itself to finance the operations of the company. Governments don't issue stock because they can't sell pieces of Chula Vista City. Now, if Chula Vista owns property, the city of Chula Vista, they can sell that property, but they're not selling the city of Chula Vista. It's a governmental entity. It doesn't work that way. So they can sell bonds, though, because they can promise to pay the bond holders back. So debt financing versus equity financing. What are some of the characteristics of bonds? Well, a bond is a written pledge. Think of it like a mortgage. You can think of it like a mortgage. To repay a specified amount, that's the face value, the par value, the principal of money with the interest. The face value, the par value, the principal is the dollar amount that the bondholder will receive when the bond matures. Now, bonds are normally sold in $1,000 denominations. And in our class, we will always use 1,000. So the par value, the face value, the principal, it will always be 1,000. Some bonds come in $5,000 and $10,000 increments, but there are far fewer, and we'll just ignore those, just for the sake of simplicity. Bondholders receive interest payments every 6 months at the stated fixed interest rate, and the legal conditions are described in the bond indenture. You could think of that like the mortgage documents that you bought, or when you borrow money to buy a car, the car loan and the like. That there's a trustee that oversees the bondholders' interests. So the trustee is your representative if you buy bonds. For example, our Southwestern Community College bonds that we sold to build the stadium and all the other projects that they're working on. The trustee is overseeing to make sure that we actually do what we say we're going to do and not throw ourselves a big party or give ourselves a big raise. And at certain times, Southwestern has been in the news for not all the right reasons, because there's been some hanky-panky that goes on with this money. I'm sorry to report, but it is what it is. The truth will set you free and probably make you sad. But the ship seems to be righted. We'll see what happens. I'm just so sad that they had to get rid of all those beautiful buildings. They were built to last 1,000 years, and we destroyed them after 60 years. It's sad. Slide number 7. What are the types of bonds? Well, there are mortgage-backed bonds, and there are unsecured bonds, debentures. Now, wait, what's going on here? Does this sound familiar? Remember secured loans and unsecured loans in Chapter 5? Yeah, same idea, except the numbers are lot more zeros. A mortgage-backed bond is a bond that is secured by various assets of the issuing firm, like railroad cars, trains or planes, or other entities such as plants and equipment. If the bond issuer does not pay, the asset is seized. Whereas unsecured bonds, debentures, I've heard people say debentures, and I'm not sure which one it is. Most bonds are unsecured. They're backed by the reputation of the issuer. Kind of like a credit card. We know it's Walmart, and we know they're going to pay us back, so we trust them. If we don't know that much about them, or if they're a little shaky, maybe we'll lend to them, but we're going to expect, a higher interest rate. And that's why bonds are rated like a credit score. Yeah. And then there are these bonds called convertible bonds. You know what? It sounds exciting, right? Convertible, the hair blowing through your wind, or the wind blowing through your hair, or whatever. Yeah, and it's not really exciting once the darn thing won't go down and it's raining, or somebody puts their foot through the cloth. Same thing is true with the convertible bonds. They can be exchanged for stock if the stock does really, really well, but usually the stock doesn't do really, really well, and we're just stuck with the bond. And by the way, they don't pay as much as regular bonds. Oh well. And then we're going to take a look at the call feature, because when we discussed mortgages, we talked about refinancing. Well, that's what the call feature of bonds is. Corporations and municipalities can sometimes call in, come here, bonds. No, they're buying back the bonds. Before the bond's maturity date, they want to refinance. Treasury bonds have never been issued as callable. That doesn't mean the Treasury won't do it sometime in the future, but they just never have. Most, though, agree not to call in their bonds for at least 5 or 10 years. That's called the deferred call protection period, or the call protection period, or the call deferral period. And the way to think of this is that it's trying to save you from immediately being refinanced and losing your high interest rate. Bonds are called in if the interest rate they're paying is higher than the going rate. It's the same idea, right? It's the same idea that we talked about when we wanted to refinance our home loan. If our home loan was higher than what mortgages now are charging, we would want to get a new loan and refinance the old loan and get rid of it. And that's the same thing is true. Now, if you're a bond holder, a bond investor, you don't like this feature because it means you were getting 7% and now interest rates have fallen to 5%. And they call your bond away from you, give you your $1,000 back, thank you very much. Sometimes there's a bit of a sweetener. They might have to pay you $1,030. Think of it like a prepayment penalty. It's called the call premium. What about taxes? Well, bond interest is normally taxed at your marginal rate. And that's always true of corporate bonds. But here's something that comes out of our Constitution. Muni bonds can't be taxed by the IRS, the feds, and treasury bonds can't be taxed by the state and local governments. It's part of the Constitution. The Constitution says the feds can't tax the states and local governments. The state and local governments can't tax the feds. So this is an important feature for wealthy investors who tend to love muni bonds. And I remember when the muni bonds were being sold, the Southwestern bonds were being sold, and there was a big presentation. I was sitting in the back, and one of the governing board members said, we have to publicize this so the people in the South Bay and the community college district will buy our bonds. They can invest in Southwestern. And I was sitting there shaking my head, no, they won't. Who buys muni bonds? People, well, maybe some folks, well, believe it or not, Coronado's in our community college district, but in other words, people in very high net worth, high income people are interested in muni bonds. And if you buy a bond in your state, typically your state will waive, W-A-I-V-E, will waive the taxes on your interest. Very cool. So if you live in California, most of you do, some of you might be watching this from outside California, but if you bought a California muni bond, doesn't matter where it is in the state, Eureka down to San Isidro, you would get a double tax-free exemption. You can't, the feds can't tax this anyway. That's any muni bond. But you would also not have to pay taxes to Uncle Cal. So Uncle Sam nor Uncle Cal. Cool, right? Now you have to be careful because if you are subject to the AMT, which means you're making a good amount of money, and some muni bonds are not exempt from federal taxes. So I don't know how the IRS got around that or the Congress got around that, but they said, oh, these really aren't muni bonds even though they're being touted by a municipality, so we're going to tax them. So there. I'm not a lawyer nor a tax expert, so all I know is stay away from these things. If you or your client, for those of you going into the business, is subject to the AMT, you must disclose that provision. Cool? Okay. Here is the formula for taxable equivalent yield. If you are looking at a muni bond at 6% and you're in the 25% tax bracket, you take the tax-exempt yield and divide that by 1 minus the federal marginal tax rate. Does that look familiar? I told you you're going to want to forget about marginal tax rate, but they were going to come back to bite you, and that's exactly what they've done. In other words, when we calculated the after-tax cost back in Chapter 3, now we're calculating the after-tax return. So you're in the 25% tax bracket. You buy a bond that's paying 6%, you take that 6% yield, 0.06, everybody understand that? Divided by 1 minus 0.25, the 25%, and it winds up that this bond is equivalent to an 8% fully taxable bond. Huh? You mean I'm buying a 6% bond and it's the same as buying an 8% corporate bond? Well, yeah. Yeah, because think about it. If it's a $1,000 bond, and in our class, they will all be $1,000, 6% of that is $60. It makes it really easy, right? If it's a 5% bond, it's $50. If it's a 3% bond, it's $30. So it's a 6% bond, we get $60 a year. If we bought an 8% corporate bond, we would get $80. And you think, well, wait a minute, I'd rather have $60 than $80. Oh, yeah? This guy, the 6% bond, you don't have to pay any taxes on. The 8% bond, you have to pay 25% of your income in taxes. Turns out that 25% of $80 is $20, so you have to take 80 minus 20, which is $60, which is what the 6% muni bond paid you. You see? And the higher the federal marginal tax bracket, the higher the after-tax return. Which is why I was thinking in the back of the room, no. If you're in a lower tax bracket, these things are just not worth as much to you as people who are in the higher tax bracket, so they're willing to buy them for more money. That's how it works. Oh, and by the way, they usually want at least $25,000 as a minimum investment. So they'd rather you give them $100,000. The bond investors tend to be wealthy, and we'll come back to this at the end of the presentation. How are we doing for time? Not bad. Okay, now what happens if it's a double tax-free? Oh, by the way, the IRS doesn't like that term, double tax-free. They want you to call it double tax exempt. Okay, IRS, double tax exempt. So what we do here is we did what we did back in chapter, we take the tax-exempt yield for the muni bond and subtract it by 1 minus the federal and the state. So if we're in the 25% federal, the 8% state, we would then take 25 plus 0.08, that's 0.33. Do it. Come on, make sure you do it. And then 1 minus that, 0.33, 1 minus 0.33, 0.67. Take 0.06 divided by 0.67. And if we were in the state of California, in the 25% bracket, 8% state bracket, and we bought a California muni bond, that's the same as buying an 8.95% corporate bond. Very cool. I think so. So, and of course, we have a worksheet. And if we have a worksheet with calculations on it, it's going to be on the exam. So don't freak out. Just do it. We would stop in the face-to-face class and do it now. And you can see it's not very hard, really. Do it a couple times. Contact me if you have any questions. You know I can talk about this stuff far longer than any reasonable person would ever want to listen. Slide number 12. Let's make the decision to buy or sell a bond. Can the corporation, the municipality, the federal government pay back the face value at maturity? Will you receive your interest payments until maturity? You're essentially playing the part of a bank, folks. That's what a bank has to think of when they lend money. So what does the bank do? They look at your credit score. Well, there are credit ratings. It's not a score. It's not a numeric score. It's really kind of silly. AAA, AA, triple B, double BB, triple C, double CC, and then D for default. Anything below triple B is called non-investment grade. Another name for that is junk or speculative. That's our fancy word for gambling. Distressed bond. The company's usually in deep kimchi. And we have these rating agencies. You might have heard of Standard & Poor's, Moody's, Fitch's. Their job is to go out there and analyze the company or the municipality or the federal government and give one of these ratings. Now, I've never been a big fan of these ratings. In the past, by the time they downgraded the stock, it was too late. They were similar to the idiot lights on your car. But now I'm not a motorhead, but my understanding is when the little red light comes on, the oil light or the hot engine light comes on, pull over. Yeah. But in the past, just keep driving. Your engine's going to seize in 2 miles anyway. It doesn't matter. It's too late. But no, nowadays, your car, the red light comes on, pull over immediately, And the same thing is true here. By the time it's down to triple C, double C, C, D, just keep driving. It's going to die soon. Slide number 13. By far, the most confusing thing about bonds is the inverse relationship of bond prices and interest rates. And I'm going to ask you this about 3 or 4 times on the exam, so you might as well learn it. And if you just keep thinking of the seesaw, that's going to go a long way toward helping you understand bonds and interest rates. If interest rates fall, bond prices rise. If interest rates rise, bond prices fall. Now, wait a minute. It's a loan for $1,000. How could it change its value? Well, think about it. The interest rate on your bond does not change. The interest rate is fixed. If it was a 6% bond, it will always be 6%. If it's a 3% bond, it will always be 3%. So the price of the bond changes. The interest rate doesn't change. The price of the bond changes to reflect the change in interest rates within the financial industry, because the price is not fixed. It's a security. It's tradable. This is a great source of confusion and consternation to many in and out of the investment world. So just remember the seesaw. Interest rates fall, bond prices rise. Interest rates rise, bond prices fall. That's a perfect analogy in my humble opinion. So let's see an example. Bond paying 10%. Now you got to go back to the 1980s, right? See bonds paying 10%, or most bonds now some bonds pay that, but they're really dangerous bonds. They're very speculative. Okay, so the bond's face value is $1,000. That means you're getting $100 every year, because 10% of 1,000 is 100. What if interest rates fall to 5%? Now, new investors are only getting $50 from new bonds. They have to buy 2 bonds to get $100. So would you sell your bond that's paying $100 for 1,000? No. If you were going to sell it, and you don't have to sell it, no one's forcing you to sell it. The result is your bond is now worth far more than it once was. If you sold it now, you would sell it for a capital gain. You could be selling it at a high premium. Now, what you have to be careful of is it callable? Because whoever issued the bonds, they're not stupid. They're seeing that new bonds are paying 5%. They could call in your bond, give you back your money, maybe pay a little prepayment penalty, and then issue new bonds at 5%. You see, that's the dilemma there. Now, what happens if interest rates rise? Say you bought a 5% bond. You're getting $50 a year. If interest rates rise to 10%, new investors are getting $100 from new bonds at 1,000. Yeah. So are they going to give you $1,000 for your bond that's only paying them $50? No way. They would demand a large discount. The result is your bond is now worth less than it once was. You would have a capital loss if you sold it. Now, you don't have to sell it, folks. You're not under any obligation. You can just continue to hold it, and eventually it'll mature at $1,000. You'll get your interest. But if you were forced to sell, or if you wanted to sell it, you're going to take a big capital loss, because interest rates falling that much, that's a big fall. Interest rates rising that much, that's a big rise. And these numbers are kind of inflated. But last year, 2022, interest rates went from 3% to 7% to 6%. Think about the mortgages, from 3% to 7%. Yeah. Ooh. Slide number 16. This is where we would do our ABCs. Once upon a time, bought a corporate bond paying 8% 4 years ago. Today, corporate bonds like WANs are paying 6%. Interest rates have fallen. Would Juan be able to sell his bond for more than he paid for it, less than he paid for it, or the same amount he paid for it? Right. Interest rates fall, bond prices rise. The bond could be sold at a premium. He doesn't have to do that, but he could. Slide number 2, El Coco. The Anglos go, huh? Bought a treasury bond paying 5% 2 years ago. Now treasury bonds are selling for 7%. Would Senor Coco be able to sell his bond for more than he paid for it, less than he paid for it, or the same amount he paid for it? He would sell it for less if he had to. And dear students, you've heard of Silicon Valley Bank and how they got in big trouble. This is exactly what happened to them. They bought long-term bonds paying very little. Interest rates rose, and then they were in deep kimchi. They had to sell these bonds at a huge discount to cover their short-term expenses. And this is a rookie mistake. You don't lock up short-term money into long-term investments unless you're stupid and you don't care, if you lose a lot of money. But if you're a bank, your job is to make sure you don't lose. And then, of course, no one's going to go to jail. Maybe a couple people are going to lose their job, but they should never have been allowed to do that. That's where the regulators are supposed to step in. And in 2018, they relaxed the restrictions for these regional banks, as they're called. With it's like shampoo, rinse, repeat. Shampoo, rinse, repeat. They tighten up the restrictions. Everything's cool. Things look good. Oh, go ahead, loosen them up. They loosen up the restrictions. Somebody stupid gets the bank in trouble. And, they were doing it just so they could get a little bit more juice out of their returns. They were buying longer-term bonds that pay better than the shorter-term bonds, but they should never have been allowed to do that. They probably paid themselves a big bonus. They don't call them banksters for nothing, folks, dear students. And this is, it gives all the banks and credit unions a bad name. Most banks and credit unions just didn't do this. But, I don't know about you, but I got an email from Mission Federal saying, we're safe and sound. We haven't done anything that these goofballs have done. And it's true. Most credit unions never get involved. Many banks never get involved in that kind of. Okay, enough, Pano. Continue. The relationship of bonds and interest rates is why a bond will have different quoted rates. There's the nominal rate, the coupon rate. Coupon rate? What is that? That's the rate that the bond pays on the original amount. If it's a 6% bond, the nominal rate is 6%. The coupon rate is 6%. It's like asking people, what's your name, Bob? Bob. What's the nominal rate on a 7% bond? 7%. Now, where does the term coupon come from? Well, it's an anachronism, which is a fancy word for saying it's something that comes from the past. Bonds used to be documents that were traded manually, and the bond had coupons attached to it. So when you wanted to get your interest payment, you would clip the coupon, write your name and address, send in the coupon, or usually coupons, because many have many bonds, and they would send you back a check. It made it very easy to trade these bonds because the next person just clips the coupon. And to this day, earning interest from a bond is still called clipping the coupon. But you know what? It very rarely, after a few years, will the bond be selling at 1,000. Interest rates are changing every day, so you will have a different current yield, and you will have a different yield to maturity than the coupon rate or the nominal rate. The current yield is the true rate of interest that the bond buyer is currently getting today, since it reflects the premium or discount price the buyer had to pay. But maybe you paid $1,200 for that bond. Maybe you only paid $800 for that bond. But when the bond matures, you're going to get the par value. You're going to get the $1,000. So we have to do a separate calculation for the yield to maturity. Okay, if the nominal rate, the current yield, and the yield to maturity are all the same, that means there's no premium, no discount. The bond is said to be selling at par, selling at face value. So let's do some calculations. The current yield of a bond is similar to the dividend yield that we learned in chapter 12. We take the annual interest instead of the dividends, and we divide it by the current market value. Price of the stock, price of the bond. So let's say it's a 6% bond. And the market value is $1,100. That's $60. Don't put 6 cents. Okay? That's if the bond we're selling for $1. It's selling for $1,000 when remember, all our bonds in this class will be $1,000. So that's $60. What's the interest on a 6% bond? $60. What's the interest on a 2% bond? $20. What's the interest on a 5% bond? $50. Don't get this wrong. Don't put 6 cents or 5 cents or 2 cents. So $60 divided by the market value, 1,100, gives us approximately 5.45%. Less than the 6%. Well, we had to pay more than $1,000 to get that $60, so we're only getting 5.45%. A bond selling at a premium has a current yield lower than its stated rate. That makes sense, right? You had to pay more than $1,000, so you're going to get less than the stated coupon rate, the nominal rate. Now, what happens if it's a discount bond? Slide 20. Say we only had to pay $900 for that bond. Now we take the same $60 from the 6% bond divided by 900, and we're getting more than the current rate. 6.667. Use at least 3 digits, please. Don't round it up to 7%. That's not wrong, but it's just not done in the bond market because that means anything between 6.5 and 7.5, and that's a pretty big spread. It's a pretty big difference. A bond selling at a discount has a current yield higher than its stated nominal rate. It makes sense. We don't have to pay full $1,000 to get our $60 of interest. Now we're going, ay, Paquito, what is this? Oh my goodness. Well, this is the yield to maturity formula. And it looks scary, folks. I know. But it's really just a bunch of arithmetic. You just plug in the numbers and make sure you do the bottom first and then the top, or the top first and the bottom. But just, do what's here in this operation here, this quantity, and then we'll do here. And do I like to do the bottom first, but it doesn't really matter. So now what is this? What's going on here? Well, there's the same annual interest amount. It's a 6% bond, so that's $60. And so what are we doing? Well, in the current interest formula, we divide it by the market value, the market price. But here what we're doing is we're dividing by the average of the par value, the face value, and the market value. And how do you compute the average? You add 2 numbers and divide by 2. Okay, that's pretty straightforward. Let's do that first, because I think that's the easiest one. If it's a $1,000 bond, but it's only selling for $900, 1,000 plus 900 is 1,900. You divide by 2. Now, come on, stop the presentation, pause it, and do the calculation. What is that? $950? Is that what you got? I hope so. Now, what's this bad boy right here? This is the one that scares people. Why did I add down here and subtract up here? Because this is doing something completely different. This is just averaging the bottom is averaging the market value and the par value. But here what we're doing is we're taking into account the price appreciation if it's a discount bond, or the price depreciation if it's a premium bond. In other words, we bought it for $900, but we're going to get $1,000 when the bond matures. So what do? We take 1,000 minus 900, that's $100. We divide that by the number of years until the bond matures, in this case 10 years, and that's 100 divided by 10, or $10. So basically what's going on here, folks, for the next 10 years, the bond is going to appreciate $10 every year. It's going to make its way back to 1,000. It sold at 1,000. It's now selling for 900. It's going to go back to 1,000 when it matures. So we add an extra $10 every year to the $60 we're getting in interest. Now, we're not getting $10. No one's giving us a check for that or putting it in our account, but our bond is going to be appreciating every year. So that's 70. 60 plus 10 divided by the 950 gives us 7.4. Interesting. Remember, the current yield was 6.67%, but because we're going to get an extra $200 when the bond matures, our yield to maturity is actually 7.4%. I know, ay Paquito, es difícil. Just do it, And don't worry about being perfect. if somebody asks you to do this on an exam or a worksheet or an assignment, just do your best and remember that my undergrad was a math major, and we lived and died by partial credit. So, so just go ahead, do your best, and if you mess up, fine. You can try again and be awesome. Okay, enough said. Enough said. Slide number 22. There are two markets for bonds. Same idea as stocks. There's the primary market where it's the first time the bond is sold, just like the primary market for stocks, where the first time stocks are sold, the one stock from a new company. And then there's the secondary market, where you buy it from another through your broker, you buy it from another investor. Well, for the vast majority of us folks, we're just not going to get involved in either of these markets because why? They want you to pony up at least $25,000, preferably $100,000 or more. Bond traders deal in the millions of dollars. Oh well. But there's a major exception. That's the Federal Treasury. You and I can buy a $1,000 bond at treasurydirect.gov for the exact same price that the big boys and girls on Wall Street get, which is very cool, in my humble opinion. And that's one of our first assignments in Introduction to Investments, is to research treasurydirect.gov. It's actually not bad. People complain about it because it's the government, so it's not Amazon, all right? But it's not bad, and it's very cool. I had the opportunity to meet the project manager for CETIS Directo, which is Mexico's version of treasurydirect.gov. And he told me, he said, yeah, we stole the Treasury Direct. We basically stole treasurydirect.gov from you guys for our version. So I was impressed. And I said, okay. So remember, we love to attack the government when they do something stupid, which they often do. But when they do something good, we should, praise them, I think. Slide 23. How are we going to buy our bonds then, Payano? Well, the same thing happened at the end of chapter 12, right? We showed you all the different things about stocks and realized that we were just scratching the surface in terms of actually investigating and choosing stocks. And oh my goodness, there's thousands of stocks, and where do you even start? We just started by just doing the simplest of measurements. Well, the same thing is true in bonds. So we found that most people buy their stocks through mutual funds. The same thing is true in bonds. Bonds are not as tricky to research as stocks, but the fact that they want us to $25,000 minimum, most of us are going to use mutual funds. Because why? The mutual fund managers, the pension fund managers, the life insurance companies, they've got billions of dollars to invest, so they get much better prices. But the exception is treasurydirect.gov. You can buy treasury bills, treasury bonds, and treasury bond notes, and they're all basically similar. They're different maturity times. And that's what we learn about in the first chapter of Business 123, Introduction to Investments. You buy them at the same price, even if you only got $1,000. So you go to a bond trader, you go to a bond broker and say, I'd like to buy one bond, I have $1,000. They're going to say, get out of here. They don't even want to deal with you. But that's not true at treasurydirect.gov. So we applaud them. Thank you very much. Slide number 24. What's the bottom line on bonds? Bonds are good intermediate term investments. They are decent long-term investments, especially good for those who would have trouble sleeping at night if they were fully invested in stocks. Do you want to eat well or do you want to sleep well? But don't be fooled. Bonds have significant risks, especially when interest rates are very low. And so many people were just blindsided in 2022. They just did not believe that bonds would fall. Well, it's happened in the past, 1994, 1969, 1994. They went down a little bit in 2000. Well, actually, some of them went down a lot, the junk bonds. But 2008, but treasury bonds actually went up. So there are times when bonds fall. But it's not... I mean, this was one of the worst, was 2022, and they fell, what, 12, 13%? Which, for bonds, that's a big jump. For stocks, that's nothing. 12% down, are you kidding? That happens every few months. So don't be fooled. Keep a long-term perspective. Buy bonds through mutual funds, and we're going to see a balance fund in our next chapter, which I think is really cool, where they buy stocks and bonds. Speaking of mutual funds, that's our next chapter, and we're going to find that they are indeed investments for the masses. But we put mutual funds after bonds and stocks because we wanted you to understand what the mutual fund is investing in. It's a bit of a conundrum. It's a bit of a puzzle for we who teach this. Some people like to put mutual funds first because they're most important for most people. Some people like to put them after stocks and bonds. Well, I'm doing both. In the Introduction to Investments class, we put mutual funds before stocks and bonds. Why? Because it's an entire semester, and we're going to lose a lot of people, and we don't want to wait and put mutual funds at the very end, because chances are you're going to be investing in a mutual fund through your work or Roth IRA. But in this class, we got stocks, bonds, and mutual funds real close to one another. So if you've made it this long, you're probably going to last until the next chapter. So that's it's not your problem, it's my problem, how to introduce these topics. But I certainly hope that you're learning quite a bit. And as we've said, the news is good. As investors, I believe the last 100 years have been awesome for investors. The last 50 years, the last 20 years, even though it's been a rough ride the last 20 years, I believe the next 20, 30, 40 years are going to be great for the economy, great for investors. If we don't blow ourselves up, die in our own waste, you've heard it before, there's no guarantees. But I'm optimistic. And I'm old. Usually as people get old, they get more and more pessimistic. But I'm very optimistic. Now, politically, I'm scared to death. The rise of authoritarianism, these bozos that don't care about anything except themselves and couldn't care less about democracy around the world, that scares me. But that's for go talk to your political science professor, okay? This is finance. See you in our next chapter when we tie these two types of investments together into mutual funds, investments for the masses. Thank you so much for being in our class. Think of how much you have learned, dear financial gurus.